The S&P 500 wipes out gains for the year and Trump looks for someone to blame. It's been a horrible week for stock investors with savage losses across global indices. At the lows on Wednesday, the S&P 500 had erased all of this year's gains. The MSCI Global Index was down 7.6% for the year, European stocks down 10%, and emerging markets down 17%. While US stocks did regain some ground last night, it's clear that a range of factors are weighing on sentiment. Trade wars and the risks of more to come, Saudi-US relations and the risks of ever higher petrol or gasoline prices, a hard Brexit, the Italian budget, and higher global bond yields are all factors that will have played a part. However, markets appear to be ignoring positive fundamentals. The US will report 3 to 3.5% growth for the third quarter later today. That's down from 4.2%, but it's still well above potential, fast enough to guarantee strong jobs growth. Company earnings remain strong, with approximately 30% of the S&P 500 companies having reported and 83% having beaten analyst expectations, according to JP Morgan Asset Management. That's hardly a compelling argument for this week's losses. US President Trump was quick to blame the Fed for this week's stock market rout, saying the Fed is the biggest risk to the US economy because he thinks interest rates are being raised too quickly. Fed officials, of course, are trying to play down such talk. Atlanta Fed President Raphael Bostic said it was difficult to say what had driven the stock market sell-off, noting the Fed rate increases and trade tensions are not recent developments. And worryingly, President Trump tweeted this week that tariffs are great in terms of raising revenue and as a bargaining tool for trade negotiations. This fits a news report that the US-China trade war is at the beginning of the beginning and should cool hopes of a breakthrough at the end of the November G20 meeting between Trump and Chinese President Xi. Amidst all this carnage in global equity markets, the US dollar was strong, all but hitting highs for the year. Now, a key part of the US dollar strength was euro and sterling weakness. In the UK, Prime Minister May held what must have felt like a war cabinet meeting this week, with planning for the government to have to charter ships to bring in food and medicines in the event of a no-deal Brexit next March, a clear indication of how big a negative economic impact a no-deal Brexit could be on the UK people and economy. The pound traded to a 6-week low below 128 to the US dollar. Meanwhile, the Italian government is standing firm in the face of increased pressure from the EU to curtail its plans for a sharp increase in public spending. Ratings agency S&P will likely follow the lead from Moody's last week when it cut Italy to one notch above junk. Mario Draghi avoided answering questions on Italy last night. However, higher Italian bond yields will be having a negative impact on banks' ability to lend. The euro hit a 2-month low. However, metals markets were resilient in the face of market ructions. Copper is up a modest 1% over the last 5 days, but the price of reinforcement bar, or rebar, that's steel used in construction, hit the highest level since late 2017 in China this week, as increased infrastructure ahead of steel plant shuttering for the winter drove up prices. Iron ore is up 20% since the July lows. In stock market vernacular, that's a bull market. Despite the improvement in commodities in China, the Aussie dollar has fared poorly on foreign exchange markets. Outside of the Scandinavian currencies, it's the worst performing G10 currency this month, this quarter, and year to date. Now, next week brings CPI in Australia Wednesday, and our read is that it's shaping up as a soft outcome, though the Reserve Bank of Australia has already flagged once-off declines in some prices. Elsewhere, we have the Bank of Japan quarterly outlook meeting on Wednesday, China PMIs Wednesday and Thursday, and the important US jobs update next Friday. And finally, a reminder, it's less than 2 weeks to go to the results of the midterms in the US. Now, this will be a factor we'll be talking about in next week's Markets Update.